Hi, everybody. Welcome to another episode of the Industrial Insights Podcast. We have Michael Bucci today with me, hailing out of Montreal with investinginrealestate.com. And he is an investor in the industrial asset class that we all know and love, and has an interesting background and story of how he got to where he is today and is growing in the area, in the country, and across the states. And so I'm excited to open it up and have it be a nice Q&A where we go through his story and part of his focus and part of the fun that is industrial real estate today. Thank you for being with me, Michael.
Yeah, thank you for having me, Justin. Appreciate it.
And you bought the book. Thank you.
Yeah, we did. We bought actually a copy for everyone in the office. I think that's how we ended up connecting. Somebody from our office added all of us to the newsletter that you have, and then that's how you had reached out to me. So amazing book. We all loved it. And although we don't do leasing, like the lessons that we learned, just kind of the specifics of how a tenant looks at a space that they want to lease was very, very valuable. And even just like the terms and the layout, like some of the things that we look at as investors, like we understand that they're important, but just seeing how important it really is for the tenant and why, it just makes things like all that more clear when we're looking at what buildings to acquire. And also when we look at a building that maybe doesn't have all the characteristics for the ideal characteristics, let's say for warehousing and distribution, how it's more clear how risky that could be in a down market, so very valuable insights in that book.
Vacancy, having buildings sit around for a long time. If this is your first cycle, you're like, no, they lease in an hour, like a no biggie. And then back in the day, it could be vacant for a year or two if it was not functional. And that is just so hard to imagine, where now maybe we can almost imagine it or see like, okay, gosh, if you're on the wrong side of what the market wants, you could be in a tough spot for a little while.
Yeah, exactly. And now we're seeing that especially with this big box space. I mean, before even the ones with less ideal characteristics were leasing, with tight shipping or, a lot of office, let's say, like they were still fully leased. But now those things are sitting vacant. They're still sitting vacant since the downturn. So yeah, it's definitely something to watch out for.
Yeah. Before we get into the origin story, maybe you could help clarify a little bit of where are we at today in terms of like as an investor in properties and the portfolio.
Yeah. So essentially today, what we do is we look for value add industrial real estate for warehousing and distribution. And more specifically, we're looking for multi-tenant space. So the smaller the units, the better. And it's just served us well because today that's what's leasing so easily. But we'll do a lot of buildings, so multi-tenant, but it doesn't need to be subdivided, but just the ability to subdivide it is what we look for primarily. We'll also do some single tenant acquisitions. I would say it's not our bread and butter, and especially now we're kind of staying away from it even more so because of the challenge in leasing it, unless we could buy it at a discounted rate. But yeah, that's what we do. And then we'll buy these assets, we'll, increase the value by increasing the rent, and then we'll refinance or exit. Very simple.
I love it. How big's the market in Montreal?
Big in what sense?
Oh, I would guess it's like 200 million square feet or somewhere around there, maybe 100 million.
Yeah, probably something around there. I would say though, like the way I look at it is more on like we canvass the whole area. Okay. So then the amount of buildings that have good characteristics for warehousing and distribution, there's probably only a good 20 to 30,000 buildings in the greater Montreal area with like okay to amazing characteristics for warehousing and distribution. So it's not a massive market, and there's a lot of people competing for the same product.
Yes.
But I guess it's good to be, a medium-sized fish in a small pond as opposed to a tiny fish in a big pond. So that's how I look at Montreal.
Yes, we're working on the pond part. Yeah, getting more ponds to fish. I love it. I love breaking down, knowing your market, right? How many buildings and which ones fit the criteria, and then you can really start making decisions based on like how segmented is that market, who are the likely, what's the profile of ownership and how long they've owned that 20,000 set of buildings, and trying to like save your data set and like work through that a little.
Yeah, so we have all the data, and then what we'll do is we'll kind of exclude a lot of these massive institutions, pension funds, REITs, and stuff like that, just because like, we could still get deals done with them, but it's just more challenging. A lot of times they have to, they have, requirements for their dispositions that, it's harder for them to sell off market, let's say.
Yes.
So we'll exclude those from our list, and then we'll go after, the people that own the asset that are either using it for their company, or maybe they only own their private investor that owns, 5, 10 buildings, or, like these are the type of people that we're really reaching out to get deals done with. Those are the people that we've had the most success with.
Yes.
And also we could cater to their needs a lot easier because, if it's an owner operator, we'll offer a lease back, or we'll offer a delay of closing so he doesn't need to pay rent. And let's say he needs X amount of time to vacate, or he needs because he needs more space, or he's going to retire, or he needs less space, let's say, we could give him the flexibility to do that and either pay rent in the meantime or delay closing and not pay rent. That's where we have a lot more success with these owners and our flexible terms, obviously.
They're less likely to be the ones to reinvest in the property and to push rents, right? So if you're buying based on rents that are slightly depressed and there's work and value to add on.
Yeah, exactly. I mean, we'll still see buildings nowadays that we've acquired or that we look to acquire where they're leasing it at $5 net a foot, whereas today's market in Montreal is like 12, 14, even up to 16. Some people push it above 16, but we're not really seeing those anymore. So the rents today, some people still haven't increased them, and they're like 1/3 of what market is, which is pretty insane.
Yes, that's the cost of optimizing for occupancy. Yeah, it's a big cost. There's such a huge ramp up. But before we get too into the weeds, let's go to where Michael came from. I love it. You got a father that was an influence in giving you introduction to the game. Tell me more about that.
Yeah, so my father, he was never in commercial real estate or anything like that. He had his own business and stuff, and he would just invest his profits into real estate. So he'd buy like small condos here and there. Funny enough, the condos that he would buy were all like kind of on the same street. He would just look online at those listings, and he knew exactly what they should be worth. And the minute he would see a listing that was like below market, he would make an offer and whatever. That was like his little real estate endeavor. But he would always tell me that you can't save the amount of money that real estate makes you. Like you're not going to make that money by saving it.
Yeah.
And so that really stuck with me. And he would always tell me, like, I need to be thinking about how to invest in real estate. I need to be thinking about how to buy these assets, because it's one thing to save your money from your job. But then, when things happen in life, let's say, it's so easy to take that money that you saved in your bank account and go, use it for something else. And not only that, but it's like, it's not increasing in value the way it would in real estate. So he would teach me all these things. Whereas if it's locked into that asset, like it's there, you're not going to just sell all of a sudden because, something happens in your life where you might need the money. You'll figure that out. You'll continue keeping the real estate, then you'll find the money elsewhere, or you'll whatever. So you just was explaining that, like, no matter what happens, if you keep those assets, you'll be like safe in the long term. So at like 16, I had asked him, I'm like, look, you talk about this all the time. How much would it cost to buy a condo? And then he told me, well, at first he told me like, like, you're not ready yet. I'm telling you to start thinking about it. Stop wasting our time here. Just like get a job and stuff. Yeah, we'll get there at some point. And I was like, no, just tell me, I'm curious. I want to buy one. And then he finally, after pushing him a lot, he said that I would take me 15 grand to buy a condo, a 1-bedroom condo at about like $200,000 with 5% down. So I told him I'd come up with that money and I would buy the condo. So fast forward a year, I was working, anywhere I could, taking side jobs, like construction sites, anything I could to save money. And I would spend $0 at that age. I was just like super hungry to buy this condo. And so I ended up buying it a year later at 17. And funny enough, I was too young to even sign on the mortgage. So they had to sign the mortgage for me. And 2 years after that, we sold it, made like 60 grand selling a random condo that we had purchased 2 years earlier. And for some reason, it didn't click in my head how lucrative real estate was. I kind of just thought like, yeah, that was nice, but
I would do it.
Yeah, but I wish it did, to be honest. But anyways, I started all these other businesses to make money, because I'm like, okay, you need to have a business that makes money to buy the real estate. You don't just buy the real estate or do real estate. And then I had many failing businesses in like online sales or landscape and all these different industries, I mean, failed. They didn't make much money. It finally clicked when I was selling products on Amazon and I got banned. And all of a sudden my revenue went to zero. And that was like, okay, this is the last straw. The one business I finally have that's making some money goes to zero overnight. And it still doesn't even make me as much money as I had made with that one condo. And so then I decided, that's it. I'm going 100% in real estate. I need to figure out how to get into the industry. And so I started asking around who could introduce me to somebody that could teach me real estate. I got introduced to the owner of Mondev. He's one of that company, and he's the owner of it, him and his brother and his two sons. They're one of the largest real estate developers and investors in the city. So I got very lucky in that sense. I went to breakfast with him and he was just telling me everything he was working on, all the projects he was doing, essentially just how active he was in the industry. And so at the end of the meeting, I was just like, look, I'll work for you for free if you teach me what you know. And then he was just kind of shocked a little bit that I had asked him, and he starts laughing and he's like, look, if you, he's like, show up on my office Monday morning at 9 a.m. So I'm like, okay, let's do it. And then I showed up. Luckily, he ended up paying me a small salary, but it didn't matter if he would have paid me or not. I was convinced that I was going to work for him for free. And right away, he was bringing me to meetings, where he's negotiating a deal valued at, let's say, 20 million or 50 million, like these massive deals. And he's just like negotiating the price on it. And I'm just sitting there and I wouldn't say a word in the meetings. I just listened the whole time. And I did that for a year. And then I decided to go off on my own. But that was how I got started in commercial real estate. So I was very fortunate. Man, it's a very easy way to bypass the learning curve when you just shadow somebody who's that ahead of you in the industry.
Yeah.
But I would say the challenge is that he was probably annoyed of me because I knew nothing, especially compared to him. So yeah.
You cherish those funny moments early on in the career where you're like, I think I went to that meeting and didn't say a single word. I said hello and goodbye and maybe a thank you, and I nodded my head 2,000 times. But sometimes that's part of that's part of starting, where you get awareness and exposure of what is possible and how people conduct themselves. And that in and of itself is its own a reward to be exposed to and to learn about.
Yeah. Funny enough, even when I would go to those meetings, sometimes they would try to speak to me and I would just be like, yeah, no problem. And I would just keep listening. I didn't even want to, I was just so focused on trying to learn what he was saying and how he was explaining it and stuff that I just I didn't care to speak. I wanted to be more of like a fly on the wall. That's how I was with him the whole time. I just was there to learn, so that didn't bother me at all, funny enough. Even I went to dinners with him where he would negotiate pricing on huge deals and he would just have me sitting there. And it was crazy lessons that I learned.
Yeah. You then said starting off as a broker is going to be a jumping off point. Why that, and how did that?
Yeah, so basically what I was doing for them is I was finding them deals and I was getting a fee for finding them the deals, but all in-house and only finding deals for them.
Okay.
And so afterwards, I kind of wanted to get paid the same percentages that brokers get paid. And so they said that would be no problem, but that, it'd be more lucrative for me to do this if I went on my own. If that's the avenue I wanted to take, that I should just go on my own and just do brokerage in general. And I could still bring them deals and do deals with them. And so with their blessing, I just went off and I started my own thing. And I was also finding deals for them as well. But then I started finding deals for a bunch of, well, not a bunch, actually, a group of probably 2 to 3 core investors that I still work with today.
Okay.
Luckily, so basically what happened is when I was with them, I was cold calling for industrial towards the end of the year that I was with them. And I started, speaking with different owners, and they were all telling me, a group of 20 of them had told me that they were leasing their buildings at $10 net. And so at first, when I brought that up to Mondev, they didn't believe it. But after I had spoken to 20 of them that all told me the same thing, I mean, I was convinced that they weren't all lying to me, that they were leasing at $10 net. And so, even Mondev was very shocked that it was actually the case because the rents were at $5 net, a year earlier. And all of a sudden, everybody's leasing their buildings at $10 net. So the rents had doubled. Yeah. So then when I went on to do my own thing, I started asking around and I was getting the opinions of other active real estate investors that know way more than me. I was asking them look, if rents double, shouldn't the value of the asset double? And then they'd say, yeah. And I would say look, let me give you an example because I just wanted to make sure that I was right because at that time I was only a year in. I still wasn't very confident in what I knew. Now it's obvious. The answer is yes. Like you could even model it out. It's if you double the income, like you're pretty much doubling the value of your building. And so, but at the time I had no clue. So I started asking, and I even made the example like if an apartment building used to lease a 1 bedroom for $1,000, and now you could get $2,000 for that same unit, like can you do that for the whole building? Like you're doubling the value of your asset, no? And they're like, yeah. And so then I was convinced that industrial real estate was going to double. And at the time they were trading for like $100 a foot, which was high still for that time. People thought that $100 a foot was high just before COVID. And then I started doing deals that way and telling everybody this whole story about like why they should buy it at 125 a foot, 135 a foot, 150 a foot. And so I did like over 150 million of deals in that like 1.5 year stint, and interest rates were so low too. It was just the perfect storm.
Yeah.
Values were doubling and interest rates were so low. And so I made a lot of money doing that, and I made a lot of connections with those 2, 3 core buyers that I was working with. And then when I had that money, I kind of asked them, I'm like, look, I want to, participate as an equity partner. And then they allowed me to join in and roll my fee as equity and also to even contribute additional equity. So then I
It's the
pivoted
holy grail
completely.
right there. Yeah, you're in the game.
Exactly. That's the broker's dream, I would say. Staying on as an equity partner, especially when you've been in it long enough. I'm sure you know this too. Like you see some acquisitions that people have done, and then you see their exit, and you're like, wow. Like I know how much they paid. I know how much it cost them to buy that building, and now to see what they're exiting for, like it's just the numbers don't make any sense. And so yeah, so I pivoted to that very quickly. And now my company still does the same thing in the sense that we handle the acquisition side of things. So we find the deals, we negotiate the deals, but then at the end, we stay on as an equity partner. And the partners that we work with, everybody has their own added value. So one of our partners is a property manager. Another partner does the financing. He's a mortgage broker. I find the deal, do all the due diligence, close on the property. So everybody has their own role. And that's what we do. And in the future, I'd like to go back to monetizing some of the deals through a traditional brokerage, which I'm in the process of doing. I'm going to have a separate entity that does brokerage still, just because 99% of the deals that we come across, we can't monetize. We can't monetize because we can't buy everything, obviously. And so I'd like to go full circle and come back to that at some point. But today, yeah, it's just we're 100% focused on acquisitions.
So the joy of creating an acquisitions pipeline. So what is a great way to do it? There's knowing your market, segmenting it. There's contacting it in a variety of different forms. What have you found works for you?
So what works for us is first off, getting the data. Like you need the data of all the properties, of the owners of the properties, the phone numbers, everything like that, their email address. So that's step one for us. Then step two is qualifying those leads. So there's a lot of leads in the industrial area that are they're either not an industrial building, they're, not the quality of industrial building that we're looking for. And so, getting rid of those so that they're no longer in our list is what we do right away once we have all the data. And then we're left with, for us specifically, it's buildings that have good characteristics for warehousing and distribution. So good shipping court, X amount of like our ideal, I guess, amount of truck level docks is like 1 per 10,000 square feet. But we'll, whatever, give or take. Maybe you could even add truck level loading docks, but just good shipping in general, I guess. And then we have, the ceiling height, higher the ceiling, the better. We have all these different characteristics. We essentially have like this cheat sheet with like different tiers and different ratings per tier. And then we plug that in for every single property. And then with that, we're left with a list of, properties in the city that we have all the data for that have good characteristics for warehousing and distribution. And then we'll contact them, any way possible. So maybe we have a mutual connection with the guy that knows him on LinkedIn, or maybe we'll call him directly or send an email, or we will go in person at the building. We'll do anything to get a hold of these people, and then we'll just negotiate the deals that way. And then how we have like the most success with the people that we reach out to is that we really cater to whatever their needs are. Some people, I mean, I guess the most obvious example is always like an owner operator. Like they can't go and list this thing publicly and then their employees get wind that they're, selling their building. Why are they selling? Are they shutting down? Is business not good? So then they get scared and they might start looking elsewhere. There's also the visits. You don't want visits all the time while you're, conducting business there. You don't know you can't trust everybody who's going to come to the visit if it's listed publicly.
Yep.
There's the other structures where it's like you wouldn't have a traditional brokerage list a property where there's a delay of closing of a year while they close down operations. Like it's not something that you would do. It goes to bid, and then whoever buys it has to close shortly after, and that's just the way it works. So for us, like we could cater the terms of the deal specifically to the people that we're working with, and that's why we have a lot of
In a
success.
vacuum too, a little bit of like what's important to you and what's important to me, and like let's hammer it out, as opposed to like how fast, how much, and like jump over this huge hurdle.
Yeah, exactly. And people they appreciate that we're so willing to, figure out what their needs are and then kind of structure something that works and fits their needs. So people really appreciate that as well.
So you must be making a lot of phone calls.
Yeah,
Yeah.
yeah. So we're a team of like 10 people now. We have quite a few people. Well, we have five people that are making calls. Then we have the back end. So we have the whole machine going. My role in the whole thing is basically, I guess, investor relations to a certain extent, and then closing deals high level if I have to get involved at that point. But yeah, they're definitely speaking to many owners on a daily basis. Like you'd be shocked how many people we speak with.
Deal screening, right? So you get a hot one and there's a spark of a maybe. What's deal screening look like for you guys?
So we'll get all their property information, but for us, we're looking for upside in the short to medium term. And if not, then if the upside's only in the long term, then we'll pay a discounted rate today. But we're most competitive on buildings where there's upside soon after closing. And so we're looking for rents that are low. We're looking for leases that are close to expiring. We're looking for a vacancy or a vacant building in general. We're looking, essentially, we keep it very simple. Like we want to optimize the rents as quickly as possible. So that's what we look for.
Yeah.
And then again, we're more aggressive with these multi-tenant buildings that could at least, even if they're not subdivided today, where they could be subdivided many times. That's what our bread and butter is, just because we have so much, we could lease those things very quickly. But essentially what we're looking for when we see this thing is high level. What is the price that they want today? And then after we increase the rent, what is it worth after that? And then are we okay with that return? And then obviously, if high level, it seems like it would make sense. If they're asking for a price that's, I guess, sort of related to today's income for the building, or even like halfway between what it would be worth once it's increased to market rent versus what it should be worth today. So as long as there's still some upside for us to unlock, then we'll look at it further. Then we'll run the pro forma. We'll show what the market rents would be, and we'll include some downtime for leasing it, the leasing commissions, all that. Then when we look at it in detail, then that's when we'll make a decision if we submit an offer or not.
Yeah. I'm sure you have plenty of deal stories of deals that blew up, or once it gets twisted, like you can't undo it, or ones where there was the surprise that you found in due diligence that is environmental, or gosh, there's so many surprises that
Yeah,
can happen.
yeah. Honestly, I try to forget about those things, but no, I reflect on those and we try to learn from them. But yeah, for sure, I've had my share of horror stories.
Yeah. And then when you think of how you finance them today, that's you and some clients from beforehand that still go in on it. Is it just you, or it's a friends and family, or?
Yeah. So basically, how we finance our deals is we'll contribute X amount of equity in the deal, and we'll do our deals with partners. So like I said, it's those same partners that we were working with before, and everybody has their own role within the acquisition. And so we'll also get a fee for finding the deal in general. So we'll usually roll that fee into the deal, and then we'll
Yep.
also contribute additional capital. And then yeah, we'll stay on as equity partners with them. And then how we do our financing is it depends the acquisition. So most of the time we have to get a bridge loan because, if we're buying something vacant or with, leases way below market, we need to close private. So we'll get a bridge loan for, let's say, 1 to 2 years while we optimize the rents and increase the value. And then we'll refinance and pull some cash out or whatever. We have to, keep X amount of equity in the deal. That's fine. But that's how we operate. Usually we have to get the bridge loan first with higher leverage, but also paying a substantial interest rate. And then after we'll get our term loan after that.
Yeah. Bridge loans make the world go round in value add.
Especially in industrial, I think. I feel like it's it's what keeps the industry afloat, honestly. It's like for apartments, you see like these loans. Like for us, we have a CMHC program where the government subsidizes the loans and stuff. Sometimes they'll have a financing clause in the offer where they might need like 6 months to finance the deal. Whereas in industrial, like if you can't close quickly, like you're not buying industrial deals. Like they're not giving you many months to go and get your financing in order. So you have to close very quickly, and that's why private is so necessary. Or you close cash, which is just, it happens, but it's not the favorite choice of investors for sure.
Yeah. How did you navigate the last year? And so, when you think of interest rate increases, inflation, and value erosion or softness in the leasing market, like all those are different things that changed quite a bit,
Yeah.
and everybody surfed that wave in their own way. So I'm curious, how you adapted to that.
Yeah. So that's actually a great question. I mean, at the beginning, when everything was happening and the rates were going up so quick, I kind of fell into the trap that, like, okay, now it's a bit of a break. Well, the market's cooled off. There's not going to be many transactions. Like, let's just wait this out and, work on other aspects of the business because we won't be doing as many deals. I think that lasted for maybe a month. And then I realized, like, no, there's just always deals. Like in a downtime, there's deals, and in the uptime, there's deals. And it's funny because when interest rates are super low and things are trading very rapidly, people will say there's no deals because the minute they find one, somebody else outbids them or buys it in 10 seconds. And then in a downtime, they're like, oh, well, interest rates are so high, I can't make sense of the numbers. And, I can't get financing on the deal. So it's like there's issues no matter what market cycle you're in. And so when that clicked, I started realizing like we just have to kind of adapt our game plan and, find out how to strategically structure deals so that it's a win-win for everybody. And so
Yeah.
we had pivoted to just, going even harder, speaking with many people, like even more people, and then also just kind of
Relationships don't go on pause just because financing is.
exactly. And then also sitting down with them and like on educating them on the reality where they would tell us like, well, I'll just wait this out and I'll sell it afterwards for more. And then I would tell them like, okay, well, look, what's your timeline of selling this thing? Like if you don't need to sell this thing today, sure, then wait until rates come down and you'll probably get more for your property. But if you want to sell it in the short term, how long do you think this is going to last? How long do you think rates are going to stay at this amount? So it was just kind of educating them on, the value today based on the rates and finding a structure that would work for them, finding kind of a middle ground. The other thing I used to do with them is explain to them, like they'd say like, oh, well, I could sell it for more later. And ask them, like how much do you want in net after selling this thing? Like how much do you want in your pocket? And then they tell me and I'd say, okay, well, we're comfortable giving you that today. Like at the end of the day, if we're closing private anyways, we're paying crazy rates for the first 2 years regardless. So if we're making the assumption that rates will come down in the next 2-3 years, then the pro forma still works. So we just found creative ways to educate the vendors and to find a win-win solution to get a deal done, and it worked. And then we got so many deals done. And also recently we had a capital gains tax increase in Canada. I don't know if you heard of it, but it was
66?
crazy.
What's
Yeah,
the number?
it's like they say 50% to 66, but it doesn't. It's the way it works is like that's how much you pay capital gains tax on. So let's say your profit is 100 grand, then you'll pay tax on 50% of that. And now, well, you used to do that. Now you pay tax on 66% of it. But it's just a very confusing way. I don't know if they try to confuse people with how they explain it gets calculated, but the reality is it used to be around 25% tax on the total profit. Now it's about 33%. So a substantial difference. This happened in July, I believe, or June, I think. We got a lot of deals done right before that because we would basically show people the math of how much more tax they'll pay if they sell, a month after that date. And so we got a lot of deals done at that point too. So I guess how we navigated everything is just like whatever was happening, we're just finding a way to be creative and get deals done and also educate customers to see like what is it that they need to sell and then how can we bridge that gap essentially.
Yeah. I love when you know your underwriting so well that you can be like transparent about like the value is this because of that. And like if you were me, you would be dealing with these same set of assumptions too.
Yeah,
And
exactly.
are these not real, what they are, and are realistic or like a pragmatic. And if they are, then you realize like, okay, got it. This is just what that is. And like, can I deal with that or can I still make that work for me?
Yeah. It's funny you say that because I find people appreciate us because we'll be transparent like that and we'll show the underwriting and like I mean this might sound weird, but I personally don't like stealing buildings. I know a lot of investors they love stealing buildings. I don't like trying to trick somebody out of selling a building that is like their retirement just to get a better deal for me.
Yeah.
So I'll show them, I'm happy to show them my underwriting because it's realistic. Like, yes, I'm making a profit and I'm doing well, but at the end of the day, I'm showing them kind of the risks associated and how I'm evaluating those risks. And of course, if we execute the roadmap to the T, we'll make a lot more money than what my pro forma shows because, if I'm underwriting 12 months downtime and I lease it in 1 month, then that's a huge difference. If I don't need to pay a leasing commission versus if I do, these things change the deal like crazy. But when I show them our underwriting and I show them that I'm giving a fair value and these are the assumptions I'm making that I think are fair,
Yeah.
they appreciate that a lot.
Yeah, without a doubt. There's usually a case where there's room for everybody. Like it doesn't
Mhm.
have to be just you profiting on that. And yeah.
Yeah,
Other
exactly.
differences, Canada, US, that people may or may not know that may be part of why you're looking to expand into the US or may not be. Maybe it could help people who are in one and haven't done work in the other make sense of it.
Yeah. So I know that you guys have way more tax advantages. So you guys have like the 1041 exchange where you could roll your profit in another deal tax free and defer your taxes. We don't have anything even close to that. So if we're selling an asset here, like we're paying capital gains tax on it, and there's very little ways to even reduce our capital gain tax on the profit of a sale. So for us, like that sucks obviously. And you guys have even like I don't understand your tax code specifically because I've never made acquisitions in the States yet. But from what I've heard, there's all these different tax advantages that you guys have that we don't have whatsoever. Another thing is like your markets are just huge. Like we have major cities and they're like tiny compared to your cities within your states, or even your state in general. Like for us, let's say Montreal is within Quebec. Montreal is like the one major city and it's a tiny city with like 2 million people or something. I don't even know if it's exactly what the population is, but it's like a tiny city relative to major US cities. So there's just so much more opportunity for you guys. For us, our major cities are like Toronto, Vancouver, Montreal, and then everything else is not as big as those three cities. But like that's it in our whole country. And also the amount of people we have, we only have 30 million. You guys have like upwards of 300. So just like a lot more opportunity for you guys. But then there's also the fact that with a lot more opportunity, you get a lot more people competing for the same assets. I'm not sure how it would look when we start doing acquisitions there and how competitive it would be. I mean, I would say something about Canada that I enjoy is like even in Quebec, French is, supposed to be the number one language. And so a lot of the people that we're working with, they speak French. And so if you're an outsider, it's a bit more challenging to enter into our market. So that's a kind of a
Yeah.
barrier to entry that we see here. So I guess there's pros and there's cons. And then another thing is about what I was saying about it's a small pond. So we're a bigger player within a small pond. I think that helps us within Canada. So different things like that. Well, actually, another big difference though, I've heard that your financing is just your banks will be way more aggressive on financing. Plus, you have a lot of like smaller banks. We have like five major banks, and that's it. So those are kind of the pros and cons, I guess.
It's like you're going to have a good time learning some of those. Yeah, and have more options available to you. That's a good thing.
What would you say is like some of the tax advantages or some of the advantages in the States that you see?
The one you alluded to but didn't call out by name was cost segregation. I'm not sure if
Okay.
you have that over there. That's the accelerated depreciation. And
Yeah.
so,
We don't know.
yeah, that's another way where you can take the cost you are putting into maintaining and kind of overcoming wear and tear of just time and how time wears down properties and the property condition. There is a tax advantage that takes that into account, which is already like that makes sense and is helpful. But then there is a method where you can like get more of that up front, and it's a way to better shield active income
Hmm.
so that you can have profit, but like from your property's cash flow that isn't being taxed at like ordinary income levels. And so between that and the 1031 exchange, that's those are huge. But with the exchange, like there also comes with a million rules of what you need to do for that to work for you. And so interesting ones that trip a lot of people up is the entity that owns the property. Like you have to sell a property and then buy with the same entity. And
Mm.
so if you have you, me, and your uncle Larry, and then three wants to go in a different direction, like you can't change how you hold title in the middle of a deal. Like you would have to all go into that deal together, and or else you start playing games and messing with like how far in advance or how far after you have sold and bought can you change the members of the entity or the entity itself. And so that just leads to and more like a technical expertise that you need to like a plan for something in advance of a property sale and what direction each person's going to go. So there's a bunch of nuance that's in there, but provided you are set up for that and like cognizant of it, then that's something you can use to your advantage. And yeah, that's it's interesting to think of like velocity, like things that like help increase velocity. And when velocity is faster, what can happen faster as an investor? You can move through properties quicker, or just the market itself, people can get where they need to go faster. And
Yeah,
so,
that's a great point.
yeah, I'm not sure it's set up for speed per se. I think it's more for tax advantages, but like that helps people get off the dime and make their move that they want to make rather than like him and ha and delay based on some of the tax ramifications.
I think if I saw the statistics in Canada, it'd probably be shocking to see how some properties just never trade hands. And it's just because the cost basis is so low that it's never going to make sense for them to sell that asset. Because after paying tax, they can't use the profit to buy an equivalent asset. So it just doesn't make sense. Whereas for you guys, it's like you're probably trading hands. I don't know what the percentage would be more than what we do, but I'm sure properties trade hands like way more frequently in the States because of this rules.
For private parties, a common part of the conversation is I can't sell unless I find a property that I'm going to exchange into. And
Yeah.
so, if you're an industrial broker, you need to have an answer to that question.
Hmm.
It's interesting that some people like you exchange from smaller to bigger, and that makes sense in the same area. But some families and estates and investors like change their interest level of what they think is attractive over time. So we have had clients that have exchanged from industrial to retail, or from California to Texas, or from multi-tenant to single tenant. And so those are things where you have to be well resourced and have good relationships, or you need to like broaden your skill set so that you can fulfill all of the back end exchanges. And so from a broker like a perspective, and even from an investor like owning my own property, I would want to do the same thing too. So it is interesting that you have to like understand it and cater to it, but there is an opportunity from a broker to then go do that deal too and participate in that and fee into it, or just there's another fee there on the other side of a sale if you like know how to accommodate their need there.
Yeah. There could be a massive chain of transactions with that same broker involved, I guess, which is super interesting.
Totally. Yeah.
Yeah.
Cool. And so, future looking forward, you're saying maybe making sense of how to monetize the pipeline other than for deals you can't buy. What do you do with those? And I could see
Yeah.
that it's hard to waste leads that you fought so hard and spent so much time to develop to just see them like not go somewhere. And then to balance that with, but that's not our core of what we do. And so, how do
Yeah.
you look at that balance and cater to it? I guess your answer today doesn't have to be your answer forever, right? You still have to like learn and test and see what's good for you.
Yeah. I would say probably the game plan right now, which, like you said, could change, is that we're going to have two separate entities. So we're going to have the brokerage on one side, and then we're going to have the acquisitions, which is the current company, investingrealestate.com, on the other side. And then we're going to keep everything separate, but it's just that these brokers here will have access to the same data that we have access to. And
Yep.
then they'll just be contacting for listings while we contact for acquisitions. And that's kind of how I see it working. And then I guess our added value to other brokerages is just going to be kind of the data that we have everything ready for them. We have all the owners' information. We have everything prepared for them to start finding leads. And then, obviously we'll handle like the marketing and this and that for like a traditional brokerage would, but our real bread and butter added value is that we're going to be like creating a sales team that's going and contacting owners to try to get listings. So that's going to be one aspect of it. I don't know how involved I'll be within that organization as of now, but we'll see what happens when the time comes. And obviously expanding in other cities in Canada, expanding in the States, like those are our plans for sure. Growing the team internally, buying more buildings, also building out a management team internally. I'd like to start doing more aspects of the deal internally, handling the management, which actually we're working on an acquisition where we would be managing it 100%. So, we're going to start building that out. Then we'll also start handling, the leasing side of things. Hopefully the brokerage can take care of leasing as well. So we just want to get even financing as well. So the game plan is just to handle all aspects of real estate in general with these two entities. And yeah, that's pretty much our game plan moving forward.
We talked about building a pipeline and screening and adding value. How about the exit? Have you exited any? You own everything that you've bought, and how do you look at exits? And have you had an example of one that you've exited on in the last year or so that comes to mind that is a good story of
Yeah,
good deal for you from start to finish?
I'll break down our first deal that we ever did, the first acquisition where I stayed on as an equity partner and our exit there. But we never sold the asset, but we haven't really exited and sold the assets. We've kind of refinanced and just held them. In the future, I anticipate.
Yeah.
Yeah, exactly. I try to keep my dad's advice and try to hold on to the asset for as long as possible. But eventually we'll start exiting for sure. But I'll run you through quickly like the first acquisition we did. This one was like a unicorn deal. Essentially, half of it was occupied by the vendor and the other half was occupied by a tenant. The tenant, they had a lease that was expiring by the time we closed on the property. And the owner, he wanted to vacate his space at closing. So the building was going to be 100% vacant essentially. And during due dil, the vendor was so nice, he allowed us to renegotiate the lease with the existing tenant. So we were able to renegotiate that lease and increase the rent to market. So that was stabilized on day one. And then during due diligence as well, he allowed us to put his unit up for lease, which was also insane. This guy was just the nicest guy ever. And so we put it up for lease, and then we found a tenant within like a couple of weeks. So we actually had stabilized the building even before closing. So that's why it became a unicorn deal because
Yeah.
yeah, it was amazing because we had waived conditions with technically half the building stabilized because we renegotiated that existing lease, and then the other unit was vacant. So we were planning that was going to take, I don't know, like 6 to 12 months after closing, and we were going to have to pay like a lot of holding costs and whatever. Well, leasing commissions we were going to pay no matter what. But anyways, so we had anticipated, yeah, interest. We had anticipated a lot more cost to that. And in the end, we put it up for lease and we found a tenant even before closing. So then we had to figure out what to do because we didn't want to finance based on our purchase price anymore because it was stabilized the assets. So we asked the vendor if we could have a balance of sale. He gave us a balance of sale for 3 months at 5% interest. So very favorable interest as well.
That's seller financing is what that is? Or
Yeah,
carrying paper?
seller financing. But seller financing, I guess, is more like a long-term thing. At least the way I look at it is like seller financing is more long-term. Balance of sale, I refer to it when it's like we have to pay the balance in like a few months or something. So in this case, we only had 3 months to pay the whole balance of like 5.2. And then so he said yes to that, thankfully. So then we were able to close. So basically we closed. We had to contribute like 1.5 million of equity, and he gave us a balance of sale of 5.2. And then we were able to refinance within 3 months based on the actual new value of the property. I mean, they didn't give us the full value of the property just because they knew we bought it 3 months ago, but they saw like what we had done, and so they still gave us more than we would have if we would have got financing, on day one. And so for this one now, our annual debt service is like so even when we refied, we already pulled out almost $1 million. So we have like not much money left in the deal. And then we had so our NOI today is like 548, so 550, and it goes up. Like today, it's already at. We had huge rent bumps in the lease because we started them off a bit lower as long as they agreed to like massive rent bumps. So now our NOI is probably around like 580. So whatever, like our pro forma is like after all the cash flows in the 5 years, and then let's say we exit in year five. I mean, if you just do the cap rate based on the NOI today, I'll do the NOI in the last year just to show you because it's pretty crazy how much value you could unlock of a building when you increase rents this substantially. But let's say we bought it for 6.6 all in. Let's say in year five, the NOI is around, I don't know, 600 grand. We exit at, I'll even do a 6.5 cap. Anticipate we could exit for a more favorable cap rate at that time when interest rates are lower, but let's just say 6.5, 9.2. So 9.2 and we bought it for 6.6. That's like we make 2.6 million and we put in 1.4, and we only have like 750 left in the deal. So it's just crazy returns. And obviously the NOI in year five is going to be higher, interest rates are going to be lower. So that was like a unicorn deal where there was like no risk involved. Initially it seemed like we're buying a vacant building, and it turns out there's zero risk. We get a balance of sale, we stabilize the building before we even close on the property. Incredible, that deal.
The risk was just getting it started and your due diligence money, and then it's what can I make of this situation? Can your like a preparedness and your research turn into something like better than what meets the eye?
Yeah, exactly. Also, there's just sometimes you get fortunate with a vendor that's just willing to accommodate reasonable requests, but others are like, you know what, until you own this property, you're not touching anything.
Yeah.
So we got lucky in that sense. He allowed us to
And
basically.
you use vendor as a synonym for seller?
Yeah, exactly. Oh, sorry. We use vendor. Yeah. Maybe it's like a French translation thing. I'm curious now.
Yeah.
Yeah, vendor.
Yeah. Hey, anytime that they understand that like you're a good partner and it seems like you're doing the best that you can with the situation and you're committed to the deal and you have some skin in the game, then the more that you can all work together towards the sale, right? All the better.
Yeah, exactly. And then like we did another acquisition. I mean, I won't go into as much detail on that one, but our most recent acquisition, a multi-tenant building, industrial, same type of asset as the other one, but this one was subdivided a lot more. There's like 10 tenants, and we bought the building with extra land. On the building is on a lot that's at least double the size of the land that would be needed to build that existing building. And so the game plan with that one is to stabilize the existing building and either refinance or subdivide the lot and sell that building alone, and then build an identical building next door on the vacant land, and then again increase the value by stabilizing that asset and then refinancing or selling it, or even selling it vacant to a user, just because once it's built brand new there may be a user that's going to want to pay for it to operate his business from. So that's the game plan with that one. But that one, like, we couldn't do any leasing during due diligence. We had to put a lot more cash in the deal to make the numbers work. It wasn't stabilized on day one. So they can't all be unicorns. That's still a great deal in our books, but it's not a unicorn like the first one, I would say.
Yeah, they're not all the same. There's so much variety there. And you could sell units off as condos too if you needed to or wanted to, or if that was advantageous.
Yeah, exactly. That's another scenario that we're looking into for sure. I mean, the building has to be set up to accommodate that from day one. Otherwise, it's a bit too expensive. But for sure, it's something that we included as a possibility. Have you done that a lot, or?
It's got started. There was in one part of town a lot of properties that were being built that were smaller ones, and rather than being a row that was divided into a bunch of units, the land was subdivided so that each unit had small yards. And so there was a lot of those small buildings for sale projects that were, I don't know, 20 or 30 of them that had gone 80 or 90% through that part of the cycle when I was getting in.
Yeah.
And then we do have a few that are close by that were built solely to be sold as condos. But I feel like very rarely do you see the existing multi-tenant park that's then condoed and sold as units. But it's out there and it's a move, and there's a time and a place. So it's good to know the move for when like that opportunity presents itself.
Yeah, absolutely. I actually remember I was listening to your podcast, and one of the guests was talking a lot about that being his strategy. Super interesting.
Yeah, Rob Guthrie. He's the man when it comes to that. That's just his jam, and that's all he looks for. I'd say
Yeah,
like a primarily. And so
yeah,
it's great that everyone can have their own spot in the investment cycle or like in the arena, and can be a player in different sizes. And yeah, I love it. It's great. I'm excited to get into investment more and maybe bring you some deals. Who knows?
yeah, absolutely. We'd love it. Honestly, we're looking for deals all the time, and we're aggressive. We're flexible. We're young, so I guess we look at things a bit differently. Some of these people that have been in the industry for a long time, maybe they'll look at a specific deal and they have rules in their head about how much they should be paying or why they should be paying that much or why they shouldn't be flexible on certain terms. For us, like whatever it takes to get a deal done, if the numbers work, like we're going to get a deal done. So we'd love for you to send us deals. Hopefully when we come to the States as well, like we could work together. That would be amazing.
Yeah. Well, I think that's a good spot to wrap up, Michael. I appreciate you making yourself available and spending the time and delving into some of the weeds. I enjoyed thinking through part of your experience and how you view things and where there's opportunities, and excited to hear your story and see you grow.
Yeah. Thank you so much, Justin. I appreciate you having me. And again, we appreciate the book that you created, Industrial Intelligence, fantastic book. And it connected us. So it was great. And, thanks for the invite. I appreciate it.
Fantastic.